Welcome to The Explainer. Today, we're diving into a whole new strategy for financial safety, one that's built for the world of 2026. You know, the playbooks that worked for the last 30 years, they're pretty much obsolete now, and the rules for protecting your wealth are being totally rewritten. So let's get right into it. So let's kick things off with this really powerful idea from some recent analysis. For decades, right, we had this relatively stable global order that just fueled the markets. Well, that era of predictable, easy growth, it's over. As the slide says, that peace dividend has been completely spent. So what's really changed? I mean, what are we actually up against? Before we can even think about building our defenses, we've got to understand the new terrain. This is the new risk landscape for 2026. Okay, so get this. The World Economic Forum asked over 1,300 global experts a simple question. What's the single biggest risk we're facing? And their number one answer wasn't a pandemic or even climate change. It's something they call geoeconomic confrontation. So what on earth is geoeconomic confrontation? Well, put simply, it's when countries start using their economies as weapons. Think about it. Trade routes, financial systems, even technology. They're no longer just tools for growth. They're becoming instruments of power. And that creates these new, highly unpredictable shocks for your money. And look, this isn't some far-off abstract idea. It is happening right now. Take China's recent restrictions on silver exports. They cut about 70% of the global supply, almost overnight. This is a perfect example of what's called resource nationalism, and it's a playbook we should probably expect to see a lot more of. So, with threats like that out there, how do you even begin to protect yourself? Well, the first and most critical step is to build a strong foundation for your financial fortress. And every good fortress needs a solid foundation, right? For us, that foundation is liquidity, basically having cash that's safe and easy to get to. Now, this is where things get really interesting. For years, the standard advice, the rule of thumb, was to have about 3 to 6 months of living expenses saved up. Well, that's pretty much out the window. The new recommendation for this landscape is a much more robust 12 to 24 months. So, why such a huge jump? Well, if we look back at the 2008 financial crisis, it gives us some clues. Back then, the median time someone was out of a job stretched to nearly 25 weeks. That's almost half a year. The thinking now is that the kinds of shocks we're talking about could cause disruptions that last even longer. Let's put some real numbers to this, because that's where it really hits home. If your monthly expenses run about $5,000, the old goal was $30,000. The new safety standard, $60,000. It's a big jump for sure, but that's what's now considered the baseline for true security. Of course, you don't want all that cash just sitting under your mattress. It needs to be safe, it needs to be liquid, and ideally, it should be earning at least some interest. So things like high-yield savings accounts, short-term government treasuries, and money market funds, those are the top spots to store this fortress cash. All right, the foundation is poured, the walls are up. Now it is time to stock the armory. This means we need to diversify our investments with assets that are specifically suited to thrive in this new, more fragmented world. You know that classic 60-40 portfolio of stocks and bonds? It's been the go-to investment strategy for decades. But here's the problem. It just wasn't designed for this kind of world. The whole idea was that when stocks go down, bonds go up, and they balance each other out. But in a high-risk world, they can both fall at the same time. Ouch. So it definitely needs some reinforcement. So what does work? Well, first up, let's talk about gold. It has recently just shattered records, surging past $4,600 an ounce. And the reason is pretty simple. When people get nervous about government-backed currencies like the dollar, they flock to gold as a universal store of value that can't just be printed out of thin air. Next, take a look at the defense sector. When global tensions go up, so do defense budgets. We're talking about a proposed $1.5 trillion budget for the U.S. alone. For major defense contractors, that's pretty close to a guaranteed revenue stream from governments all over the world. And all that massive spending has to go somewhere, right? It goes to companies like these. You've got firms like Lockheed Martin, Northrop Grumman, and RTX getting huge contracts for everything from advanced jets to missile defense systems, which, as you can imagine, are in very high demand right now. Now, building the fortress is huge, but it's really only half the job. This isn't a slow cooker. You can't just set it and forget it. You have to actively maintain your defenses, which means running ongoing drills to make sure your fortress stays strong. The best way to do this is with an annual financial reality check. And this is more than just a quick glance at your statement. It's a 3-step drill. First, you assess if your assets are still aligned with the new reality. Second, you hunt for any hidden leaks like tax inefficiencies. And third, you really stress test your whole portfolio against some worst-case scenarios. And a huge part of that stress test is asking yourself some really tough, honest questions. You have to look at your holdings and ask, can this actually survive 2 years of total market chaos? What happens if the dollar loses a big chunk of its value? Seriously, understanding where you're vulnerable is the only way to fix those weak spots. Okay, to bring this all home and make it super practical, here is your action checklist. First, expand that emergency fund. Second, think about adding strategic allocations to things like gold and maybe some defense stocks. Third, and this is so important, pay down high-interest debt. Think of it as a gaping hole in your fortress wall. You have to patch it. And finally, commit to running that portfolio stress test every year. And really, all of this boils down to one central idea, this new philosophy for 2026. The goal isn't just about getting the highest return on your capital anymore. In this kind of environment, the priority has to shift to resilience. It's about ensuring the return of your capital. In a world this turbulent, the ultimate goal is building a fortress that can withstand whatever comes next, making sure your capital survives to grow another day.